Asset Management. Today is Tuesday, April 26th, 4:37 p.m. Eastern Time. Coming to you from St. Augustine Beach, Florida with tonight's Revere Market Insight video. State of the market, we're in a correction. You can see over here by the trend gauge, market leaders, short-term trend, medium-term trend, long-term trend, all in bearish mode, which means leaders got hit really hard late last week. Only five of our 21 over 21 from last week survived. That was enough to take us to bearish/downtrend on that. And on the different trends, all five of the major indexes are below their respective short, medium, and long-term trends. This is how we know to get the heck out of the way of the market, paying attention to the signals that it's given us. So what just happened? Another ugly deep red day. Bearish action continues is a pretty good summary. We broke the lows from Friday, and in the case, some of the indexes broke lows from prior in the correction. Just not a good market environment. G6 really got slammed down 3.8%. S&P 500 down 2.8%, NASDAQ down 3.8%, Dow down 2.4%, midcaps down 2.9%, Russell down 3.3%. Global diversified 60/40 stock and bond down 1.6%. Our in-house flagship portfolio, GROTECTION, flat on the day as we have been all in cash since Friday morning, shortly after the open, when the rest of our stops got hit. So let's get into the charts. Let's get into the deep red. We're going to take a look at some of our recent sells. 14 recent sells, and in all 14 cases, the current price is lower than where we exited. This is why you want to be sure now, no matter how much you like something, you need to stick to your stops. And if you're interested in this approach, reach out to any of us at Revere. We're trend followers. We follow the trend of the market. Can't make the market go up, but we can be in sync with it, which means when it's going up, we can make money. When it's going sideways, we can limit our exposure. When it's going down, we can get the heck out of the way. Email any of us, Dan, Tim, Hunter, Muriel, or Don at revereasset.com, or call 855-REAL-WEALTH. Danny will answer that. That's 855-732-5932. So let's dig into the charts here. So here's the S&P 500, and let's bring up the tail of the tape also. So as I said, market state correction. We got the same headwinds. Strong U.S. dollar. Dollar was up again today. We've got inflation really hitting our spending ability, getting less for our dollars. Fed tapering and balance sheet reduction, another headwind. Interest rates rising. Russia-Ukraine war. Lot being thrown at the market. Put call ratio sentiment was peaked at 1.3 last week, 1.06 today. VIX up again, big time, at a 33.8 level, up 25%. Fear and greed dropped 13 points from 40 all the way down to 27. That's approaching extreme fear. So our bull case, that failed on 4/14 when the rally failed, and we're in bear case. This was confirmed last Friday, 4/22, with the rally failure and the break of all the moving averages, and now we're breaking lows, and all this is happening below the 200-day moving average. Let's take a look over here at a chart of the S&P 500. This black line, this is our, they don't ring a bell at the top, but in my opinion, they do ring a bell when you break below the 200-day moving average, because no serious correction in the history of the market has ever started without a weekly close below the 200-day moving average. So a lot of bouncing around, and here we undercut, reclaimed, tried to reclaim and failed. And now we're banging on the lows from March on the S&P 500. The NASDAQ 100 actually broke its lows, and I'm pretty pretty sure small caps did too. This 4,200 area has been a key support level. Actually, it's when you consider the closes here from 3.8 and 3.14, we went as low as 41.58. And after hours, we're actually breaking this area here, not down as far as this 41.15 yet. And the reason why we're breaking is because of poor reaction to earnings to Microsoft and Google. That's going to drag techs even lower, and it's certainly going to hit the S&P 500. Speaking of techs, here's your NASDAQ 100. You can see our low today 316.88, closed at 317.14. That's below this prior low. And you can see down another 1.5, 1.6% after hours, down to 312. Ouch. Really breaking below, and that's going to take us below this 316 level over here from back in May. Really not a good look for the NASDAQ 100. Let's go back to the tail of the tape here. So we confirmed the bear case, really nothing of note as far as news goes today, although you could argue Tesla down 12%. There's some rumors out there that some people that do not want him to buy Twitter are banging on Tesla stock because if it breaks to a certain level, he gets a margin call, and those were the funds that he was supposed to be using to buy Twitter. So never a dull moment on Wall Street. So what were we watching today? Primarily we were watching for support, 4160 to 4200. Let's go back to the S&P 500 here quickly, and closed at 4175, but lower by, let's see what the SPY's doing after hours. SPY down 0.8%, so we're clearly below that, below this 4160 to 4200 spot. Also Qs, I mentioned support 317.45. I've checking to see some things that we recently owned or got kicked out of the 21 over 21 last week to see if they're holding their 50-day moving averages. Anything with a green check mark is still holding. Anything with a red X is below its 50-day moving average. And again, this is a further sign for some of these quote unquote leaders in the market to see what they're doing. So the action today, gap down 0.7%, frozen slope lower down to that 4,200 area, then a noon bounce, but a weak last hour and a close at the end of the day. Let's go to a 5-minute chart on the S&P. Here's your frozen rope lower, very similar to the action on Thursday and Friday. You see we got a reprieve yesterday and a nice bounce, and a lot of people saying, oh, that's fine, we held 4,200, we're in good shape. Well, here 2 tests of 4,200, 3 tests, and then we finally broke below it after 3 o'clock today. All the way down. Let me change this to the S&P 500 so you can see the actual numbers versus SPY. There's the break of 4,200 in that 4160 to 4120 range during hours, lower than it after hours. So what's the next level I'm looking for? Twice during this sell-off, do we have huge shakeouts and then bounces? Let's go to, it was on January 24th here. On February 24th here, in both cases, we got between 9.4 and 9.8% below the 50-day moving average. So what I'm taking a look at is when do we reach this 8% level? That's at 40.46. Below that is 4,000, a nice round level, and that'll actually be down around 9% below the 50-day moving average. A very obvious spot to bounce. We'll see if we do. It's actually a low risk entry there. Extreme oversold bounce. It worked last time. We may or may not take it. We're keeping an eye on it. So that's the next level to keep an eye on, 40.46 on the way down. As far as what was up today, the dollar, which is not good for stocks, bonds up, oil up. Really commodities were up today, but the commodity stocks were a mixed bag. On the downside, we had big bounces yesterday from SOX, software, and Chucky. That's XLC, XLK, and XLY. Those are the 3 tech ETFs that make up the majority of the S&P 500. They were all very red today, down 3.3, 3.7, and 5% respectively. Banks continue to get hit. KBE down 3%. Retail had been taking a bounce. That was down 3%. Biotech bounce. Was down 6% today. And Jets, 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 everybody getting very excited about the bounces in 3 of the major airlines, United, American, and Delta. last week, but Jets was down 4.2% today. No trades in-house. We continue to be all in cash. And the bottom line, bearish action under the 200-day moving average continues, and cash is king. We've done multiple studies and we talk about it constantly. Not much good happens to the market under the 200-day moving average. That's where risk is at its highest. That's where we're at our maximum defense. This entire big bounce up where Kramer announced that the bear market was over at 4,600 has been completely undone over the last 3 weeks. And we're following the trend of the market, getting the heck out of the way. So tomorrow, the 21-day moving average will cross below the 50-day moving average on the S&P 500, just indicative that the shorter-term trend is worse off than the intermediate-term trend. And of course, they're both still below the 200-day moving average, so we're getting no help from the look of the moving averages relative to price. Really, bottom line, as I said, bearish action under the 200-day continues, cash is king. So let's take a look at a couple of charts. And really, we talk about the market being a feedback mechanism. You buy something, it's going to go up, it's going to go down. You can't argue with it. Actually, first, let me finish up the indexes. You can see here the Dow Jones Industrial Average not breaking the lows of March yet, but breaking yesterday's low. Mid caps, MDY, down around the spike lows from January, February, and March, and IWM small caps did break 188, yep, 187.67 did break below the lows from January, February, and March. So, like I said, 5 of the 5 indexes below their moving averages. That's why we're in full bear mode across the trend gauge. So, talk about the feedback mechanism. Take a look at where we sold some recent things and where they are now. When you get out, we always track when we sell something because we really consider it to be true that we're in the best of the stocks, and we make it stopped out, but there may be re-entry points after we get stopped out for them. That's one of the reasons why I'm watching those stocks that were listed on the tail of the tape relative to their 50-day moving average. But here's 14 recent sells that we did. Oxy at 57.7, it's at below 55 now. And you're going to see a consistent theme here. These things either breaking their 21-day moving average or some other key support level. We really pay attention to our stop levels, or if they didn't hit the key level, maybe they hit our maximum percent stop loss. That was the case for Tesla. Was still above the 21 when we sold it, but it broke below the low of the gap up day when we entered it here. So we sold at 1,104 and 1012. After hours, we're at 864, breaking all key moving averages. CF, fertilizer stock, they've been extremely strong. We got out at 99 when we broke below the 21. We're at 95 now. On that Dow, we were holding on to the Dow as it was showing some relative strength. It's still showing relative strength, but it's still the price action. You're losing money if you stuck in. We bought it when we broke above the 200-day moving average. Next day, hard reversal below the 200-day moving average. That's where we got out around here at 347.8. We're at 332 now. Healthcare, the sector held up for a while, defensive. Still from a relative strength standpoint, not bad, but this really gave way on Friday, and we sold it early Friday morning. This is one of the last positions that we were in when it broke below the 21-day moving average, got out at 136.7. We're down to 132. SPYV, this was the value portion of the S&P 500. Again, still showing great relative strength. In fact, relative strength at a new highs, but price sure isn't at a new high. You don't get paid on relative strength, you get paid on price. And when this broke below, actually this hit our stop. We didn't want to go negative on it. We sold out at 41.38. Actually was when it broke below the 21. It's below the 200 now, down around the 40 level. Mid caps were outperforming for a while. You can see the relative strength here. They gave that up. We protected our profit, selling out at 485. It's at 459 now. Chevron, one of the leading oil stocks, we got out at 167.6 when it broke the 21-day, down to 156.5 now. CCJ, uranium stock, pretty excited about this entry. turned completely around. We got in when it bounced off the 21. Next day broke below the 21. We got out at 29.3. It's down at 26. I suggest you kind of do this exercise too. Keep track of where you sold out of things and see what's happening, because they were leaders, and if they're not continuing to lead, then the market, it's a classic Livermore quote: if you can't make money in the leaders, you're not going to be able to make money in the market. And this is just confirmation that we're making the right moves by getting the heck out of the way. GFI was a leading gold stock. We were really happy when we had this big gap up on the 18th. Next day it gave it up, bounced back above the 50, then broke down again. And that's when we sold at 1420-ish. It's now at 1323. CrowdStrike holding up great. Had a huge upgrade from Goldman Sachs, took it above the 200-day moving average. That's when we bought it, quickly gave it up. Last week we got out at 218.7. It's at 201, clinging to the 50-day moving average, looking like it wants to go lower. SPLG, this was just our way for broad exposure. But when that gave way, we got out at 51.3. It's at 49 now. This is a S&P 500 index fund. Apple, should you ever sell Apple? You should sell Apple if you've got losses in it, which is what we had with Apple. We took a low risk entry point when it broke back above this 50-day moving average, and then bounced when it came back, but it gave it up. We sold out at 167. Back up this way on this big negative reversal. It's at 150, closed at 156.8. It's at 154, down 3% after hours. That's really not good. And then finally, MP, rare earth, great thing to be in. They're the only U.S. company that really mines them. So breakout, nice run up. In fact, it reached that power from the pivot up 20% or more in less than 3 weeks. You're supposed to hold those. We don't follow that rule. Rolled over, broke below. We sold it right here when it broke back below 50. When it broke below the 21-day moving average, it's all the way down to 38 now. The point of this exercise: monitor what's happening to your stocks, even if you sold them, because it might look for another entry point, or it'll confirm that your feelings that the market is weak, which is the case here, are confirmed. So that's going to wrap it. As always, like to hear from you. You can email me, don@revereasset.com, or you can phone 855 Real Wealth. Cash continues to be king with the way the market's acting. Really no two ways about it. So wrapping up Tuesday, April 26th, this is Don Vandenbord. Just the facts, telling it like it is. You might not like the facts, but they are the facts. Don't argue with the market. Thank you. Have a great evening.